Welcome to the People, Property, Place podcast with me, your host, Matthew Watts, founder and managing director of Rockborn. This is a podcast where I share the stories, views, opinions and career journeys of the movers, shakers, innovators and leaders in the real estate industry. Welcome to the People, Property, Place podcast. Today we're joined by Zac Goodman, founder of TSP. TSP is a vertically integrated real estate investment company with an award-winning property management capability. Their mission is to build an investment business that remains relevant to its time and place, one that chooses rehabilitation over ruin, partnerships over rivalries, responsibility over excuses, combining deep operational capability with a progressive investment ethos to provide wealth and security for investors and people. At the 2022 Estates Gazette Award, TSP scooped up 3 trophies: Best Workplace Award and EG Tech Award for 30 Leiterman King's Cross, and the Inclusive Design Award for MS Society, Finsbury Park HQ. Zac studied politics at university before joining Goldman Sachs as a graduate, and since leaving Goldman, he's gone on to set up multiple real estate ventures. Zac, welcome to the podcast.
Thank you very much for having me.
Not at all. Well, I know you've listened to a few of these podcasts already, and you know a place that I always like to start these conversations is how did you get into real estate?
I came into real estate in a very indirect way. So after leaving Nottingham, I went to work for Goldman Sachs. And I suppose as a context and a prelude to that, I was always the kid that was selling you something in school when you were younger, whether it was chewing gum or videos or whatever. And I'd built a small business with a couple of friends in Nottingham, but it was relatively successful. And it was my first real taste of entrepreneurialism, working in partnership with people. And as Nottingham was coming to an end, I sort of asked around and sort of said, what's everyone doing? I'm from Manchester. And so one of the obvious options was to go back home, find a job. And a lot of the guys and girls that I was friendly with, they're like, well, we're all going on these grad schemes and, you know, probably moving to London and what have you. And amazingly, that kind of passed me by when I was in university, sort of planning for what happened afterwards. So very stupidly, I just said to one of my friends, well, which grad scheme pays the most money? He turned around to me, I still remember it now, and he goes, well, Goldman Sachs does, but I wouldn't bother applying there if I really. After hearing that advice, I went home, pulled open the application form to Goldman Sachs, didn't have a clue what to write until that moment, hadn't intended on being a banker or anything, and had all these boxes in the questionnaires. And so I just decided to write my story of how I got to where I was by then. And in the first box, I wrote, don't know what the question was, but what I wrote was, my friend has just told me not to bother applying for a job here, but here's my story and you can make up your own mind. A few weeks later, quite frankly, amazingly, I get a phone call. I've been invited to an interview. 22 interviews later, I've got a job. I graduate. I'm going to New York for my orientation, get back, work in India for a year, come back, and sort of go on this whirlwind for about nearly 5 years, having the most incredible experience in education. And then suddenly having a crisis of conscience and realizing I'm not a corporate guy. This isn't for me. It's not right. I became unhappy. And a very, very good friend who had been my partner in Nottingham, and he knows who he is, came to me and he's like, what are you doing? This isn't you. And he gave me a book called Who Moved My Cheese, which is an allegory about change.
I've read it.
He bought it me as a kind of, that was his claw hammer to knock some sense into me, basically. And I basically quit my job about a month later. None of my friends believed that I'd quit. My parents were in a state of shock. And I had another friend, and he was, he had been working for a property fund, which was going bust pretty badly. It was 2009. And so he was looking for something to do. And I was in this fortunate position where I'd earned quite well at a young age. So I had a little bit of money in my pocket to kind of not retire or anything like that, but certainly pay the rent and think about what I wanted to do and take a breath for a second. And so he was like, look, I've been in property, it's pretty good. I know very few people that haven't done well in property and the rest of it. That being said, it was 2009 where there was blood on the streets. But I like property. My father was in property when I was younger. I loved architecture for a while. I considered it as a university course. I considered it as a career, and I was put off it by the advent of CAD and computer automated drawing. I remember my dad saying to me, you'll be a draftsman and then you'll get replaced by a computer and all the rest of it. That was sad when you think about it, and not true as well. So long story short, I got into property through total serendipity. I had a friend that was already in it. He was working for someone that was very soon to go bust. I was just in a space where I wanted to do anything else other than banking. And so we set up together
So you set up a business together with him?
We set up a business together, and literally we bought a load of letterhead. We rented a single room in Hendon, Yellow Pages job, computers on the desk, phones, started banging the phones. And the idea was we both wanted to get straight into an investment. I was pretty good on finance and what have you. And he'd learned a lot in his time in real estate, doing leasing, he knew what he knew, and it was a lot more than I knew. But we couldn't get anyone to back us to go and do investments because it was 2009 and we were 25. So we just decided, okay, let's just do something clever. Let's go and advise, consult, restructure, go make ourselves busy. And we were like, what should we do? And I have to say, it wasn't my idea, it was his idea. But he said, well, you know what? The one thing I've noticed is there's a lot of charities in the UK that own property. No one set up especially to advise them or do anything. It's tough times, it's the credit crunch, it's this, it's that, it's here, it's there. And we did the analysis and he was 100% right. There was 167,000 registered charities at the time in the UK, the third sector. And they were basically the biggest freeholder of property in the UK. I mean, if you include all the churches and everything else, I mean, by far and away. And a very, very large occupier as well. This was back in the days when, the charity shop businesses were booming. Oxfam had 300-400 shops around the country, and a lot of people were following suit. This was 15 years after the new Labour government had come in and started using charities as effectively government contractors to solve a lot of problems in society, whether it was generational unemployment, whether it was, drug rehabilitation and so on and so forth. So there was a lot to go at. And so we signed this room in Hendon, we called every charity. We were basically rent knockers, and we said, look, it's a tough time in the market. We can see you've got the following leases or this, that. Let's go restructure it for you, save you some money, this, that. And everybody just put the phone down to us and said no. We got some odds and sods of instructions. And then 9 months in, we got Barnardo's. And it was a tiny instruction, but it was Barnardo's. And the gentleman who instructed us said, I'm not going to pay you very much, but I guarantee you when you tell other people that you're working for Barnardo's, it will mean something. And he was right. And then all of a sudden the floodgates opened, and we did a considerable amount of business in a very short amount of time. And with the money that we made from that in the early days, we started to build a small team around us. And it was small, modest, and none of us knew what we were doing. We were terrible at hiring. And then about 3 years in, we'd made enough money to have a bit of equity to go and say, well, let's go do an investment deal. And
so the work, can you just tell me about the work that you picked up? What was that work that you were looking for?
Oh, I mean, it was everything from your lease is coming up to expiry, so we'd go and do re-gears. And this was during a time where, there was a really high vacancy rate. The high streets were being absolutely battered. Office market had got near 10% vacancy and what have you. And we were dealing with people inside and outside of London. So in a lease expiry scenario, we'd basically saying, well, do you want to stay there? And they'd be like, yeah, we do want to stay there. So we'd be like, okay, we'll go and leverage your landlord for you and we'll do a negotiation. And we'd get them, in some case, years of rent free, because the landlords were just petrified about losing tenants. And charities are incredibly good tenants. I mean, never mind the fact that it just ethics is in their corporate structure, but they don't typically have debt. So they're a cash flow positive organization. They pay the rent on time. They don't behave like businesses behave, if you like. Not that businesses on the whole behave poorly, but they certainly can do a lot more often than, say, a charity. So there was lease regearing, which was a good business. There was rent reviewing. It was a really interesting time to do rent reviewing because so many businesses had upward-only rent reviews, but the market had gone down by 30-40%. So you had a lot of charities that were exposed in office buildings or retail environments where their lease basically said their rent cannot go down. But you'd be in a shop paying 40 grand, in the next door shop you could rent for 0 and just pay the rates. So there was all these interesting like leverage and arbitration opportunities that existed in the market. And we were helping these organizations to effectively take advantage of them. And as we were a small business and we really had nothing to lose, we basically worked on a no-win, no-fee basis. And we got good at it. And so we were able to do really well, to the point where eventually charities sort of, when we were doing repeat business, were like, well, I think we need to have a cap somewhere here and what have you. And it took us into dilapidations negotiation. And it was basically, we became specialists in unpicking the old wise ways of how landlords used to basically hold their thumb down on top of tenants, which was, the old property game, as we once knew.
And your business partner at the time, was he a qualified surveyor?
No, neither of us were.
So you were doing rent reviews and re-gears and quite complex LMT.
By negotiation. So by negotiation. So, and we'd always sort of said to one another, if it came to the eventuality that we needed to go to a point where there was professional witnesses required or into arbitration and what have you, we'd made really good contacts in London where we'd said to them, look, this is what we're doing. And they were like, go at it. You can do it. You're not, it's not a regulated activity, but at some stage you may need some help, give us a call. And we'd made arrangements for those scenarios, but they so rarely do come up because using the courts to settle property disputes is bad for both sides. And I think that's probably one of the biggest lessons I learned about real estate coming into the industry, is that actually so much is achieved by negotiation. And that negotiation is driven by leverage and the leverage of the position you're in and the position that they're in.
Had you, just going back to school and politics at uni and being told not to apply to the Gold, were you a good student at school? And were you like academically gifted? Or were you, it sounds like you were selling anything you get your hands on and selling it to your mates and a bit of a wheeler dealer. Where did you fit on that?
I'm an unusual character, so straight A student, but quite creative, quite into the arts, the liberal arts. And I think that my father's from like a German family who were bankers and accountants. And my mum's from a family who were basically originally Lithuanian peasants who came over here and were market traders because that's what they had to do. And so I was incredibly influenced by both sides of the family. Like, on one side of the family, it's this kind of very Germanic, everyone get there early, quite serious, quite conservative, quite prudish, quite proper. And then on the other side of the family, my grandfather was basically a reincarnation of Del Boy, but taught me everything I know about how to negotiate, to trade, to see value. And so I had this odd combination, because to get into Goldman, you obviously had to sit down and do like maths exams and all sorts of other things like psychological assessments and what have you. So I had a bit of both. I think where my intelligence definitely hits its limitations, and it did do when I was in school, is when you start getting into deep theoretical stuff. So I was always very good at, for example, maths mechanics, maths stats, but pure maths took me a long time to get it. Once I've got it, but it takes me a long time to get kind of into the deeper level stuff. Whereas there was some geniuses sat next to me that could look at, calculus and differentiation, do it straight away, but they couldn't do arithmetic. And so, I don't know if there's any rule for any individual and how their brain works.
And then just before we progress the story further, what were you doing at Goldman? Like, what were you actually working on, or which sectors or industries?
So I started in FX, in their trading business. I was in a support role. So I turned up on my first day there in a 3-piece suit with my hair slicked back, and the guy that became my boss just laughed at me. And he was like, I don't know where you think you are. And he led me over to I think it was a printer and a fax machine next to each other. And it was basically the Reuters conversations of traders coming off it. And he said, basically, so the conversations would print off, and then I'd have to pull those off and then put them into the fax machine. And that would be our offsite data storage. There was I suppose, when was it? 2005, 2006. There was no cloud, let's say. Things worked way more old fashioned than you might have thought. And so I was there for a while. Then this opportunity to go out to India came up, and I just went, like literally with 2 days notice. And then I got back and I was sort of like, was getting the nod from some people and all the rest of it. I got moved into the interest rate swaps business, which was it was a fascinating business when, the credit crunch happened and what have you, and hung around there until I think my final day was January the 31st, 2009. You got paid your bonus, I think, the last week of January or something. And even though I'd been told my bonus beforehand, I stayed just to make sure it went in the bank before I actually walked out the door. But the truth is, we'd already started the business to some degree a month or two before. So there were definitely a bit of moments where I was moonlighting and slipping off to a conference room to take a call and what have you.
Did you talk to your dad? You said your dad had done a couple of real estate deals. Was that an influence in terms of you wanting to get into real estate?
Yeah, he'll hate me saying this because he'll probably listen to this podcast, but he was an influence and an inspiration in the sense that he went very big and then basically went very boom. He built up a huge portfolio towards the end of the 1980s and the beginning of the 1990s and was doing really, really well and effectively overexpanded and leveraged, interest rates went to 15%. So he wasn't the only one that got tagged. A lot of people did back then. So, the 90s was definitely a period of time for me that was marked by hardship and adversity and watching things not go right. And so, but yeah, I did speak to him at the time. But I have to say, I'm probably less of that person now than I was then, but I didn't really listen to anybody when I was younger and in my 20s. I was a bit of a bull, headstrong, just went and did what I wanted to do. And so that's definitely something I've learned later in life is to just, put the lid back on the pen and think for a minute and listen.
And how did you meet your friend that you set the business up with? And what were the skill sets that he brought to the table?
Well, the primary skill set was that we were both available and we were both hungry and we both needed to do something. You call that a skill set. We met when we were younger. We didn't go to school together, but we were friends. And we'd both gone different directions in terms of different universities and then different career paths and what have you, but had always stayed in touch. And I suppose it sounds childish now, but I think we decided to go and do this thing, having a cigarette out the back of his flat one day. I mean, that is the beauty of your 20s, but anybody in their 20s listening here, if you're not married and you don't have kids and you haven't got responsibilities, you effectively have very, very little to lose. And so in terms of different skill sets, I was quite analytical, I was financial. After being at Goldman's, I kind of knew my way around an organization. I knew how to do spreadsheets, I could model, I could talk a little bit. And he knew property. He'd been in it for quite some time. He understood leasing. He had a really good idea about how we had these leverage opportunities in the market. And I have to give him full credit for that. And he'd come up with this idea for the charities, which when, you didn't have to do much research to establish that this was a good idea and that it would certainly be an opportunity for it.
Why were CBRE and JLL, the big advisory business, why were they not tapping into this? Were they just too tunnel visioned in terms of their focus?
I think firstly, like the larger firms deal with larger clients on the whole. And in certain parts of the cycle, they'll tell you that they deal with smaller stuff. But the reality is, these are global businesses wanting to look after the biggest prize payers in the market, who are the private equities and the funds and some larger family offices now. And yes, if you walk along to them with one of your properties, they'll offer you their services and what have you, but they're not geared up to deal with the more granular stuff. We were dealing with the trash bag of property because everything that we did was awkward, was small, demanded a huge amount of energy, and needed people who didn't value their time properly, which was me and my partner at the time. And that was there were some firms that sort of put on their websites that they did charity advice pro bono. Pro bono advice is the worst advice in the world because neither side is empowered in that relationship. If someone's giving you something for free, you can't really tell them to speed up with it or hurry up or do this or do that because you feel indebted to them. And if you're doing something for free for someone, unless you really do have the time and resource to focus on that fully, you're not going to do the best job for them because you're not incentivized to do the best job for them and to push for them. And so it was just one of those moments in time where we saw this odd gap in the market. And I must tell you, people followed in once they saw what we were doing. And so there are firms now that have very good, very strong specialist charity departments. We know them well. We competed against them back in the day and that world has changed. And ironically for us, it's very odd for our business now because we're an investment and management business, but we won't let go of our charity advisory. We still do it to this day. Admittedly, we don't do the smaller headachy stuff anymore. We don't, because we can't offer the resource to do it. Yep. So we deal with bigger problems and bigger issues for our charity clientele. But I hope we will always maintain our charity advisory, however incongruous that may sit with some of the other business that we're doing, because we like doing it. We like working with them. They're wonderful organizations to work with. And it's the genesis, it's the etymology of the business, really. It's why it's called TSP, the third sector property, the charity sector.
So bringing the story back up then, you'd grown a small team and you're doing some odds and sods and
a motley crew is probably what I'd call them, as opposed to a team. Yeah, so we get to I'd say 2012, and by this time, we've brought on some chartered surveyors. We are now an RICS accredited surveying firm with a property management desk, with an agency desk, and with a professional desk. And we'd gone through phenomenal growth, hundreds and hundreds of % growth a year, and we're in this sort of really difficult phase. We're probably at like 10, 11 headcount at that stage and growing fast because of the amount of instructions that we were bringing on. But we've got no organization whatsoever. So one day someone sends me an email and it's got investors and people, this rosette or something, this insignia at the bottom. I turned around at the time to my partner, who's just to be with a pod, he's no longer my partner, but I said, this investors and people, we need this. It looks so professional and what have you. And not thinking, actually, this investors and people, this is a great framework to use to sort out our business organization, help us with the next phase of growth. It was that immature, young in business, like, I want that badge. And so we bring them in, and we had a foosball table. We always had free drinks and food. We were like that from the get-go. It was that generation of sort of post-Google and all the rest of it. You were cool if you had free snacks in your office, and if you had a foosball table, you were hitting a whole new level. And we had cool artwork, and we were cool. Well, we thought we were. So the investors and people consultant comes in. We're showing off, and we're like, look at this, and our people do this, and the business is growing. And she's like, that's great. I'm going to go and talk to all your people. And then, so she goes and talks to them. Then she talks to us. And she goes off and she says, I'll return you your reports, your assessments in a couple of weeks. So a couple of weeks later, JVW, who's the MD of the business today, but back then he was our contacting officer for the RICS. He was the next most senior person there. He comes back in with a report and he says, you guys are not going to like that. Basically, we didn't even get the basic accreditation. Not even the basic one. And I'm like, I've never think this is impossible. I've got a table football. And what we basically learned was that none of our staff had job roles or descriptions. None of our staff knew who their direct managers were. We, the partners, didn't know who our direct managers were. No one could locate a business plan. No one had reviews. No one understood the process of how a business plan was put together. And in fact, I had been quoted as saying, oh, well, me and my partner just go off to a hotel for half a day. And have a couple of massages and then just bang something down on the side of a black and red book and then we just tell everyone in a meeting, grow. We didn't spend anything on training, and what little we did spending on training, we didn't actually record properly anywhere. We were just a revenue machine. All we cared about was just build, just make money, bring in we were obsessed from the get-go with business development, new clients. We had for a team of 10, I think we had 2-3 people that were full-time just cold calling and soliciting and sending emails, sending letters, tops and tails, and what have you. We just gave no time to that. And we were starting to feel the pain of it. Suddenly you realize, we started to have staff that were going off to work at other places. And we didn't do exit interviews, nothing. We just, hired more. And so I said to JVW, I said, I want to get this invested. This is probably the best thing that I've ever done in business up to this point. I said to JVW, I want to get this investors and people thing, and I want you to get it for us. And it was probably a laziness thing at the time that it just felt too hard for me to get it myself. But it was also brilliant because it was my first act of proper delegation, of actually saying to someone, look, you go do this. And he took it on. And basically, I think within 2 years we had it. And within 3 years of that, we got to gold or platinum or something. And we still do it to this day. But out of that came proper business planning, personnel reviewing, our attrition rate dropped, there was proper organization. And we started to experience what I would call orderly growth. And we're taking the business in the right direction. And this was crucial because basically we wanted to be property investors, not just property managers and advisors. We never had any time to properly go at the investment side of things because something would flare up or there was a pitch for a new client and what have you. And at this stage, we were actually winning some major business in our management and advisory, like major business. So that process of professionalization probably started to happen in 2012, 2013. So like 3-4 years into the business. And it was really out of necessity just to create some time for us to focus. We found the first property that we wanted to buy. And it's really interesting now because I'm reflecting on that time a lot right now. And all I can tell you is the first property that we wanted to buy, it was number 4 Pear Tree Court. It was on the market with the receivers at Lambert Smith Hamilton. It was 8,000 square foot. It was lower ground with mezzanine above. And it was basically 250 quid a foot. And every fiber and every bone in my body knew that was ludicrously cheap. And we were still everyone was still using the phrase credit crunch. We were still, there wasn't a lot of cash around. Our business, certainly, we'd never had even an overdraft. We'd have to sign a personal guarantee just to get a photocopier in the office. And we'd done a development management job just around the corner from this building for a charity. And part of that job had been, so we bought them the building, we project managed the refurb of the whole building. They were to occupy the first couple of floors. And then we had this balance, which they wanted to lease out in order to provide them an income which would subsidize their occupation there. And again, this was a typical us deal. We'd taken them out. They'd had a portfolio of 3 properties. So we took them out, disposed of it all, bought them the property. We did the whole thing, cradle to grave. And then we would manage it after for them as well. So we'd leased these 2 floors. They're only small floors, like 1,000, 2,000 square foot. And at the time, rents in the area were, 20, 25 quid. And this was 2012. We put these 2 floors out, brand new, shiny, and they were perfect, out to lease. And we were flabbergasted with the response. And we had it was as Clerkenwell was really getting going. And people were offering 35, 40 quid a foot. So I'm sat there looking at this building thinking it's 250 quid a foot. It's really nice. Typical Clerkenwell stock, exposed brick, big windows, industrial look, the whole lot. And around the corner, I've got this building that I can rent for 40 quid a foot all day long and twice on a Sunday. So 40 over 250. I mean, you could do the maths, right? There's a deal there. And we went around and tried to raise money for it, through property people that we'd met along the way. And everybody turned us away. And I mean, everybody turned us away. We went to a really wealthy investor that had been doing it a long time. And he actually sent someone to go look at it. So we got to that stage. And that person came back and said, the boys don't know what they're talking about. And we were deflated. And then we were both sat at our desks at the time and said, well, I guess we just got to go the friends and family route. And so that's what we did. We went to friends and families. We said, look, we're going to put this in. It was an absolute conviction bet for us. We bought it. 9 months later, I think we returned, it was like 85% IRR. Smashed it out of the park. And we knew it. There was never a moment when we bought it, we were in doubt. There was never a conscious moment of thinking, oh my God, what have we done? This, that, and the rest of it. We knew it the whole way through. And we did the whole thing cash as well. There was no leverage. So the IRR would have absolutely gone ballistic had we put even the smallest amount of leverage into it. And so it's really interesting, from that point on, everything kind of got worse because nothing ever looked as good as that. It's like going into a casino for the first time and winning. It's a great feeling at the time, but it actually doesn't necessarily serve you well the next time you think it.
So you raised a lot of friends and family. Were they real estate investors or, did they have an understanding of the deal or?
I think nearly everyone you meet in life is a real estate investor when they want to be, or they've done a deal, or they bought a flat, or they did this. It was a mixture. There were some real estate investors. There were people from other walks of life who were just good businessmen and women who knew what they were looking at. And I think one thing that we've been very good at, and which I still retain to this day, when we present stuff to clients or investors, I am obsessed with the presentation of it. It should be clear. It should be as professional as it is humanly possible to be, because I think that invokes confidence in the person reading something, that someone's really taken their time.
So learned from Goldman?
I think it was. I think it's partly learned from Goldman. It's partly learned from my grandfather, who was effectively, a market man and a retailer. And he was obsessed with his shop window. And some people say don't judge a book by its cover or its vanity and all the rest of it. But there was a fastidious fastidiousness to him about how he would present his goods for sale. And I think the same remains true today. So these investors, they kind of knew what they were doing. They also had faith in two young guys that were actually, I suppose if I was to invest in me back then, you'd be thinking to yourself, well, he's taking a big bet here. He's got everything to lose now, because you make a loss on your first one. You're not doing it again. It wasn't a huge deal. I think the purchase price was 2.1 million. We raised 2.9 million in total. This is how stupid and green we were. We raised the sales costs, which you deduct from your completion monies. No one had spotted it through the whole thing. So we'd actually raised the money to pay the lawyers and the agents at the end off the sales fees. So we actually over-raised by, 30, 40 grand just for that. And I remember thinking, won't do that again. That was a bit silly. Yeah, so we raised 2.9. I think we sold it 9 months later for, 4.7 million or something like that. It was remarkable.
And what return had you guaranteed your investors? And had you structured it like a typical GP-LP type relationship at that stage or not?
It was a sponsor setup. So we put our money, our equity in pari passu with all of the other investors. And then we had a performance fee that was taken out of profits. At the end, there was no management fee. There was no acquisition fee or anything like that. It was very basic. It was rough ready. We need to get some track record. And also we need to get this deal. This thing was, we were so petrified that someone else was going to realize what we'd found here. And the irony being, it had been laying around the market for ages. It was just forgotten. And so it was a very, very simple structure. I think it was bought within a limited company. It's 10 years ago now. Struggling to remember. But needless to say, everybody was very happy. There was a lot of pats on the back that we got. And we kind of knew we'd smashed it within 6 months. We did a very quick 3-4 months refurbishment of it. And we were being offered by tenants to lease it. And when we could see the value of what we could lease it for, we knew we had a winner there. And it was lovely. It was a really fun and exciting time. And we were learning a lot of new things.
Did you split the business at that stage? And you had like your management charity piece and then
we did. So we set up the investment company under a brand called North Hill, which is sort of no longer a trading brand, but with North Hill, we went on to do about 400 or 500 million pounds worth of deals. And we kept TSP separate. And fast forward to today, that was one of the big things when my partner and I went separate ways. I decided that there's no need for me to have two different brands. Like TSP is the original brand. So everything we do is under TSP. And, sometimes we might do an investment platform underneath a different name, but everything's happening really through TSP. And if we're using our balance sheet to invest into stuff, we're doing it through the group of companies that is.
So can you give me a bit of an overview of TSP as it stands today? And you might have just touched on some of it then, but how...
TSP is a group of companies owned by myself. On the one hand, we own Third Sector Property Limited, which is a management business. Through TSP, we manage and control, I think it's about £1.5 billion worth of real estate. And that goes nationwide because we still have some charity clients that we manage their whole portfolios for that are spread across the entire country. Different levels of management. We just do property management for certain real estate. We do asset management and property management for others. And then, of course, Third Sector Property also manages all of my stuff. Also within the group, we have a smaller sister business called Switched On Space, which is something that I set up. I suppose it was more a side hustle than anything else during the pandemic. And that basically is a business that has relationships with a lot of the major prop tech product manufacturers in America and Asia. And in effect, it's a reselling business. So we buy prop tech from the partners and then resell it on either to our clients that want it, into our own investments, and also into third-party clients as well. And we got involved in some really, really interesting projects with that. That kind of took us global for the first time. We did one project that sort of spanned over 6 continents, which was amazing. And then as well as that, there's our balance sheet investment. So most of what we invest in, we're operating, as in buying investments and then doing the asset management, the value add. But we do diversify a little bit. So we also go in as an investment partner. So we're currently invested in building out 15 apartments in Bromley with Goldman Property. We're invested in a couple of small sort of enterprise businesses, which anything that we invest in has something to do with property, whether it's within the supply chain of property or just into directly. And so that's the group really. It's kind of all singing or dancing. I mean, I'm not trying to make out it's a global conglomerate, because that is definitely not.
It's not yet.
But it's something that, started now 14 years ago. It's grown, it's evolved. And our main business is investing in real estate and adding value to it. And in particular, adding value to it through the operation of it.
Yep.
And something that we recognized a long time ago as serviced offices started to come into the fore. And we're not serviced office guys. We do flexible product, but you have to operate your property. And that's becoming the differentiating factor between successful real estate businesses and unsuccessful real estate businesses, which is let and forget is dead. It's a very, very difficult business to just have a purely passive interest in today. And it's going to become more and more difficult to just invest in it and have a passive interest tomorrow. We are trying to continually develop the product that we offer out in all sorts of different ways. But we really now have to think about what we do as certainly in offices in particular, which is the vast realm of what we do as, treating it like a hotel business more than anything else.
Is that a paradox then, given your management part, which is kind of third party with these charities who don't have the in-house expertise? Is that juxtaposed with what you've just said from
running it? Quite the opposite. It forces them into our hands. And it's, just to be clear as well, it's not just charities that we manage for. In fact, it's through the years, we basically built relationships with a lot of banks, institutions, propcos. We kind of saw what we were doing, and we come to it with a different flavor than going to, say, just a standard property manager. We come to it with a boutique and entrepreneurial flair. Like, we're happy to take stuff that needs to be changed, knocked around, that is going to be time intensive and that needs some TLC.
With a landlord hat on as well, which I guess is an attractive part of it. And that's not just Bernardo's, retail, high street retail stuff. Is that everything from the whole supply chain, from logistics to office HQs to out of town retail?
Yeah, I mean, I think at one stage I was basically almost the sole manager of drug and needle exchanges around the country. If I'm honest with you though, like the vast rump of what we manage now is mixed use schemes and multi-let offices. And charities are a much smaller part of our clientele than they once were. But the point I made earlier is they will always be an important part of the clientele. But we started to attract a lot of propcos and entrepreneurial investors and also non-entrepreneurial investors as well, who had become dissatisfied with the style and type of service they were receiving from some of the bigger houses. They wanted a more personal, entrepreneurial, and close relationship with the people that were managing their properties day to day. And I also think that in the larger houses, there's a lot more churn, and they appreciate sort of the long-term nature of a lot of the members of my team. They've been around a long time at the same place in an industry where people seem to be moving more and more and more and more all the time. So there's some continuation. So some of, our longest standing clients been with us for 12 years. We're a 14-year-old business. And my longest standing employee has been with us for 12 years as well. And we have we're not a huge business, but a lot of the people here have been around for a long time.
Yeah, that's something I was going to come on to later about building a high performing team. But can you just run through, so from an investment management perspective, the type of kit that you look to buy and the angles and how you go about structuring those?
Yeah, I mean, a real bird's eye view, we look to buy things that are mispriced. We look to buy things that we have a contrarian view of in a dislocated market. I know that sounds like gobbledygook, but firstly, mispricing. Real estate is a business of imperfect knowledge, and there's a lot of things that don't get priced right. And that can be to do with poor advice. It can be to do with timing of the market. It can be to do with knowledge that we bring to a certain situation that other people may not have. Pear Court is a classic example. No one could see that you could go rent it for £40, and therefore no one wanted to buy the asset at £250 a foot. So we're constantly looking for those opportunities. And that is the business of looking for needles in haystacks. And so you have to try and get really good at looking for needles in haystacks. Contrarian view in a dislocated market. I read this book by Sam Zell, who's one of the greatest property investors of all time. His book's called Am I Being Too Subtle? And he has this famous expression, which is when everybody's looking left, I'm looking right. And I think if you really look at some of the greats in investment, they're actually more interested in assets that no one else wants. Because there's a greater opportunity of being able to successfully purchase these things. And if you've got an idea for how you can add value to it, or you feel actually that the market's wrong, that doesn't make you a mad person, as long as you do your homework and you work it out. And, it'll bring me on to, what we're feeling at the moment, which is we look at offices at the moment and there's a system-wide view from everyone in the world that they're finished and what have you. And quite frankly, we feel we're just getting started with them and it's beginning to become quite an exciting place. So we look for those type of opportunities. And, these things do typically end up being thematic, because as you get into them and as you start to develop interest for them, you start to uncover some of the drivers that are really sort of probably at first subconsciously saying to you, there's something here. People want this. There's demand there. Why is it? And you start pulling these things apart and working out the mechanics of your investment. What is driving value in my investment? Is it my cost of finance? Is it my entry price? Is it purely just on location? Is it a market right thing where the value is being re-rated? Or is it the way it's being operated? How is it being operated? How are they balancing cost with what they're receiving back in revenue? And so we get very, very analytical about these things. And once we've gone through that phase, we come out with sort of a criterion of what we want to go and buy and why we want to buy it. And it's a box ticking exercise. And if we have conviction, we move extremely quickly.
And as there's been a lot of flux in the market right now. How do you see the market and where do you see the opportunity?
I think there's been more than flux in the market. I mean, we are going into a new paradigm of investment. And this is now consciously the second time that I've seen this happen. The first time was when I was in banking and 2008 happened and the world changed. And everyone said, funnily enough, in 2008, never going to be the same again. The world is over. We'd come off this incredible high of the 5-6 years beforehand, which had been absolute boom and excess and craziness. And I remember one of the personal assistants at Goldman's in 2008, I think she had 5 or 6 flats in central London. I mean, it wasn't a normal thing. But that was the time when everyone was running around buying houses on 100% mortgages or 125% mortgages. You buy something for 100,000, they give you 25 grand back. So we're coming into that time now, and that time is dictated by the cost of capital. So we've just been through 12 years where, there was effectively zero, in real terms, there was 0% interest. And that's had a very, very peculiar effect on risk and reward and behavior in the market. One, sadly, which I don't think I've taken advantage of enough, being in real estate over the last 10 years, it was often hard to sit there looking at your cash flows on spreadsheets and having to look at the real world and gravity of bank finance and how the real world works and cash flow. And then you're sort of seeing people raising tens and tens of millions of pounds off a post-it note and an idea and a pitch deck in a room full of venture investors. So for me, it was always paradoxical anyway, the last sort of paradigm. But where we're going now is now exciting for me, because we've clearly come to the end of a cycle, which has both been good and bad. Before, at the beginning of last cycle, we didn't have businesses like Instagram, WhatsApp, Uber, Deliveroo. Don't think we had vaping. We certainly didn't have kind of Elon Musk's SpaceX and all the rest of it. Like, if you look at the last 12 years, I'm not sure how important everything is, but the dial has been moved. The way we live has been changed. The way the next generation has come through is profoundly different to the generation, my generation, that came through the sort of noughties, if you like. No one finds an iPhone novel anymore. No one, I remember when everyone was running over to the one person that had one, just have a look at it, and we all couldn't get over what we were seeing. And I think we're going back into olden times. I think cash is very much king again. I think cash flow is king again. I think profit matters. And that's going to be very, very hard for a lot of businesses across the aisle. It's going to be very hard for venture-backed businesses who are no longer going to be able to just run into a room and say, I've got this wild idea, give me money, give me money, give me money.
And just loss-making for years and years and years, but they keep raising.
Correct. So, a lot of those businesses have effectively deferred failure for quite a significant period of time. That's not to say there won't be the next Facebooks and all the rest of it that come through. Of course there will. And I think in real estate, it's a lot more challenging to raise money now. I mean, it was hard when I started out, back in the day, hard to the point where I couldn't do it. But now even more so, I think track record and having some credibility in the marketplace of knowing what you're doing, but it's going to count for a lot more. And I think in general, for every company, gone from this radical change of just being able to access liquidity and cash very, very easily, and that being ingrained into the foundations of your business model. And that's no longer there. And that makes it hard.
Is it no longer there, or is it just more expensive? It's still there and you can still access it. It's just the cost of access.
I think in many cases, for many people, it's either no longer there anymore or it's prohibitively expensive where it doesn't make sense for them to transact the business. And so I suppose you could ask yourself, well, was it good business in the first place? I mean, one thing that we always did during the low interest days and when we wanted to demonstrate to investors that we really were adding value was we benchmarked the MSCI index against our returns, and we took the MSCI index as par. If you bought the thing, did absolutely nothing to it, didn't spend a penny on it, you'd carry in that market anyway. So how much did you outperform that index by? Because that's really what you've done, what your ideas, the value you've added and what you've brought back to the table. And I think that would be interesting for many people to do a regression analysis on. There's a lot of people right now that over the last 10 years made a lot of money in property and probably feel very, very clever with themselves. But you have to ask yourselves how much of it was a carry trade and how much of it was genuinely, buying right, picking right.
Riding the wave, capturing the upside.
But with this change comes massive opportunity. I wouldn't have been able to start my business in 2008, 2009 and get a leg up if there hadn't have been market dislocation and arbitrage opportunities. It was a time back then when anybody could just go start a business, and everybody did go start a business, by the way. So many people were out of work. So many people got chucked out on their ear from the big corporates. I remember, this is why my friends thought I was mad leaving a secure job during that time. I'd walk out my offices on Fleet Street and there'd be graduates walking up and down the street with sandwich boards over them with CVs saying, hire me. People were desperate for jobs. People took extended years out, 2 years out. Whole generation of bright graduates just missed the boat. It was a tragedy of epic proportions at the time, and it's changed a lot of people. It's changed the path that they would have taken. So look, there's all the horrible stuff and the shake up, but when things do get shaken up, the world becomes ripe for disruption and barriers to entry tend to drop. People get given a chance. If you're a small guy running a little business with a yellow page and all the rest of it, you'll probably squeeze yourself into a meeting with someone that you ordinarily might not have been able to get in with. Pitch them, and if they like, what you've got to say, then you may well get a chance. Whereas when the market's booming and everything's going and all the rest of it, people tend to just want to be fast, go with who they know, go with, and what have you. So I think it's exciting if you've got an idea right now and you're starting up a business. But what I'd say is start up a business where you've got a real business plan and there is some hope of driving some revenue and, it's a sensible endeavor, if you like, however disruptive or exciting it may be. And then, values are changing and there's volatility, and volatility is a great opportunity to spot mispricing. It's a great opportunity to spot, a contrarian theory. It's a great opportunity to find a dislocation in the market. I think you can see it in the financial world. It's already happening ahead of us, where actually for the last 10 years, hedge funds have sort of been shrinking and shrinking away as people invested into ETFs and algorithmic driven investment platforms. And actually you can see all the active managers, the hedge funds, are filling up with cash again, because now is the time to be jumping in there and really finding the confusion and what have you. And, you've only to look at the listed markets at the moment. There are some property companies there where if you take their market capital or their net asset and divide it by the number of square feet they have, there's 50-60% discounts in the markets. That's, it's a £10 note for a fiver, as I used to say. So there's huge opportunity, but it's scary. I think we're in this in-between moment in the market where everybody's peering over the edge, looking sideways at one another and waiting to see who's going to jump in first and have a go. And then I think there'll just be, like always happens, everyone will follow.
It's always hard to pick when that will happen. How close to that point do you think we are, and what would need to change for that to accelerate?
So I don't think there is one dividing line for it, and I think in certain sectors we're past that point already. Like there's certain areas of the market that I'm looking at thinking, wow, I need to be in that, and there's certain areas of the market where I'm like, whoa, stay well away. That's not cooked yet.
Can you elaborate?
Yeah, look, I think offices are super interesting. I think that the press, I think the general investment world, I think the money management world is taking a fairly sort of macro market global analysis of it and saying, oh, it's done. But I think if you start digging into it and looking at it, there's a lot of sort of substrata within there where actually it's busy and it's transactional, and there is pockets of demand in places. And if you try and work out why is there demand there, what's driving that demand, how deep is that demand, how well served is that demand, you will find lots of opportunity to find underserved customers in the marketplace who are yearning. Likewise, there are areas of the market where I think things have probably been overhyped and remain that way, you know. But again, within that, I want to caveat that, but industrial is a classic example for me. Industrial obviously went absolutely parabolic earlier last year, and it had been on an upward trajectory for a long time, and you know, we've seen that cooling off a lot lately. But again, when you really speak to industrial guys, you know, you'll find out that there's 20 different types of industrial investment. You know, there's not one. And so I think what's happening at the moment is when confidence tends to get low, people pull back and they start indexing. And what I mean by that is they just start treating, you know, industrial as one whole monolith of investment, office the same, tech, growth, value. You start hearing like the more people pull back, the more people use just singular words to describe it. They generalize. And that's where opportunities arise. Because actually, if you don't generalize and you get very, very specific and you really start delving into the transaction data that's going on, why stuff being bought there, how, what's the reason for this, what's pushing it, you will start to be able to develop a view on something, and you might be right, you might be wrong, but it will give you a sense of confidence one way or another.
We spoke earlier about your team and how long they've been with you. Can you give me a little bit of insight into your learnings around building a loyal and high-performing team?
Yeah, I mean, the one thing I'd say is, as a precursor to everything is, and it's something that I should have done when I started the businesses, but it's really good to try and learn to be a manager before you hire people. Even if it's just reading a book or doing something, and not purely thinking that your ego alone is going to herald you and your team into the future and success and everything. And that's basically what we did when we started. We didn't have a clue about managing people. And we thought everybody worked in a very linear way, which is they're just driven by their compensation, and the more performance-related compensation that you can give people, the better that they'll work. And we didn't think about any of the glue that you need to create as a manager in order to have all of these people moving in the same direction at the same time. We didn't really contemplate, well, I certainly didn't in my 20s, about the fact that life happens to everybody, myself included, and how to handle that as a manager, and how to build trust with the people that you work with, and how to pick people up when they're down, and also how to create an environment where they'll pick you up when you're down, and how reciprocal that relationship actually is between whether you're a manager or whether you're colleagues and what have you. So to really understand that it's kind of there's a biology to a workforce, and it's very, very complex. And learning how to recruit, you know, and not just say, you know, yes to the yes men and what have you, and really try and analyze for the right fit for your organization. And I want to say, like, I'm not here speaking as someone that's succeeding in that wholly. It is a constant learning that is as much joyful as it is painful at any given moment. But yeah, I built a team around me, and there's a lot of people around me that have now been with me for a significant period of time, and they're phenomenal people. And they're there, I think, firstly, they're there purely on merit, and you know, they've worked into the positions they're in purely on merit because they're brilliant at what they do. But there's a culture amongst us, and that is, you know, we're all long-term thinkers. Real estate is long-term. My expression with the business as a whole is it's a long game. And they're people that, yes, of course, they're focused on their compensation and where that will take them in life and what options they'll give them. But they're also focused on their life and, you know, what level of autonomy are they getting? You know, Could they earn more somewhere else? Possibly. Would they have as much autonomy? Possibly not. Would they get as much experience or this or that? There's so many different things to balance up. Do they trust the people that they work with and who they work for? Do they believe in what they're doing? And all of these kind of things I learned really, like with the whole investors and people experience, I learned this as I went along and I did it backwards. And if I could go back, I would have got into it much more early. A lot of the real wisdom around me when I started the business, they all said to me, it's all about people. And I just probably batted that off and like, pay
Profit, your deals, it's originating stuff.
It's all about deals, man. It's all, as you start to scale, there's very, very few businesses where you can scale without needing other people to help you. And by the way, that's not just people that work directly for you or directly with you. It's your whole ecosystem, because it's your suppliers, it's your customers, it's your investors. It might be your shareholders if you have them. You have these stakeholders all around you. And if you can't get all of these people to really work with you, then you're going to just effectively be trying to grow your business with the handbrake on. And I think we really, in our line of business, certainly in the management side of the business, you're often in a sticky situation. There's a leak or there's a critical event that happens that you need to respond to. And actually, you're reliant on people outside of your business, your supply chain. And, whether it's in construction, whether it's in maintenance, whether it's insurance, legal, accounting, you name it, we've worked with some phenomenal people and companies in the industry that really know what they're doing. But, it's even better because we've invested in the relationship with them. We take that little bit of time to go and get to know them, maybe invite them to drinks at work, maybe we've been out for lunch with them and what have you. It really counts when you need help and you're looking around like, who can I call to get me out of this one? So yeah, management isn't just an internal thing. It's not just about your direct team. It's your whole ecosystem of people that you come into contact with.
I can see from LinkedIn, you're a family man. You've got a picture of your kids on your LinkedIn, which I absolutely love. How do you balance work and family life? And has your view of success changed since getting married and having kids?
Yeah, massively. My view has definitely changed since having kids. My view changed before having kids because we found it very difficult to have children. But, family first. And that's a rule that I'm still learning to stick to properly, but I'm getting a lot better at as I get older, and creating boundaries. This hustle culture, this money never sleeps culture and all the rest of it is bullshit. You really want to create harmony in your life where actually most of us probably wake up in the morning and dream that we can do just the right amount of work, that we really enjoy our work. It's intellectually stimulating and satisfying. And for that exchange of labor in whatever we're doing, we get enough, recompense back that we can live a really nice life, give our families what they want. And, most people that close their eyes, visualize that walking down the beach, carefree with your family, with them looking up at you lovingly, knowing that you're delivering for them, not just financially, but as a parent, as an inspiration, as a partner, whatever it may be. When I got married to my wife, it was a really tricky one for us because we got married in our late 20s. A lot of our friends had already got married and started having kids. We wanted to get onto it. Long story short, for us, our first child was lucky number 9 after 5 years of trying. And that was the first time in my life where there was no money or there was no level of energy that I could apply to the problem to fix it. It's completely humbling. It's completely out of our hands. It's very, very hard. It's very heartbreaking and it feels endless. And so actually I realized before I had kids what was important, because I had sat there and had to contemplate potentially not having kids and all of those other thoughts that will go through your mind. And I don't know if it's from a cheesy movie or it's someone's told me, but that concept of visualizing yourself lying on your deathbed and looking back over your life, like you're conscious of the fact that you might be about to go anytime. And it's sort of asking yourself, who do you want to be in the room with holding your hand? What memories are you thinking of at that time if you look back through your life? And this kind of building perspective over what we do, I'm really into that. Because the last few years has been stressful, with pandemics and the ups and downs of the business world and stuff. And I think at the time it's all consuming. And actually those are the times where you want to double down on your family. And those are the times where you want to think about this and say, this is just a speck in my life. This is, if your phone charges to 100%, this year might be, 1.5% of your battery life. There's plenty more to go. It's a long game. Kick back, relax. So that causes me to want to create more and more boundaries between work and personal life and get it into balance, and not try and wear hard work as this badge of honor that I think is happening a lot on social media and other places.
Yeah, it's interesting. My wife and I also found it really difficult to have kids. And we've got a kid on the way end of March. But going through that process, it took us a couple of years and failed rounds of IVF. It's like the first real challenge that I certainly found, that you can't outwork, outsmart, outmaneuver, outnegotiate. And my wife runs a business as well. And I think it's a very humbling experience. It's almost like certainly I saw it as a rite of passage. And I definitely haven't spoken to anyone about it. So this is the first time I'm really opening up about it. And I'm really excited about how it's going to shift my perspective from work. And that's why I was really interested to get your take on how you balance work and family as well.
There's no balance required for me. It's out of balance. My family is more important than my work. It always will be. And, it's really interesting you saying you haven't spoken about it before, because I couldn't speak about it probably until a couple of years after I had Lily, my first daughter. I took this approach of, whether it was keep calm, carry on, or be this image of the northern lad, everything's all right, crack on with it, and all the rest of it, which was, probably a very archaic, male chauvinistic way of going about dealing with it, wanting to be strong, wanting to be, nothing's affecting me, look at me, I can hammer through it. Probably did a lot of damage to myself with that attitude. But it was interesting, once I had Lily, and I don't know, it's not like I openly talk about this all the time, but there was other people within the industry that clearly had worked out or knew or heard something that I'd, had a tough time with it. And this slow trickle of young men started arriving at my office, and it was always with a text or a WhatsApp or an email of, do you mind catching up for a coffee or something? And you just had this sense that it wasn't about business. And since, Lily's coming up to 6 years old, I must have had conversations with 10, 15 guys over that period of time. And I found it incredibly rewarding in a form of kind of cosmic payback to either give these people solace, give them guidance in terms of, where I've gone and where I've found success with it, whether it be a doctor or this or that, or just how to look after yourself, or how to look after your wife as well, or partner, going through these times. But I think we live in this mad world in London, this bubble, and we're all basically microwaving our brains to death, in work and the fast life and all the rest of it. And in the grand scheme of things, when our work and business, it matters a lot. And for all of us, I'm sure it would be one of those thoughts, what did I build, when you're on your deathbed and what have you. But yeah, perspective is required.
Well, thanks for sharing that, because I've definitely struggled with it. And I've got friends as well going through similar things. And I know that as blokes, they struggle with it as well. And I think talking about it, I think is really important. And I think if I heard myself say that 2 years ago, I'd be like, what are you on about? Shut up. You're not...
Order another pint.
Yeah, exactly. You're not the emotional, person to discuss. So thanks for being open and honest and enabling me to share that as well. And I wouldn't have done unless you said it. And also part of me probably doesn't want to say it just in case. Yeah, just want to wait until he arrives back end of March and he's all good and my wife's good as well. But there you go. You've got it out there.
To each their own is what I'd say, and if it feels right to you, then that's great. I think the key thing that I'd say to any guys going through this is just speak to somebody. Doesn't necessarily need to be on a podcast listened to by thousands of people. Actually, it doesn't matter if it is, because externalizing it, I think, more positive things come from that than negative things. Let me put it that way, and it's definitely something that I should have done. And I suppose linking back or segueing back to your original question about management and people and teams, I think the biggest change that I've experienced over the last sort of 14 years of being a people manager is mental health, is taking account of people's lives, and is understanding people as humans in the workplace and what they go through. And I think this goes... from everything from, the Me Too movement and how that, I'm a male boss. I think our business is probably about 75% women. And I never really thought about that. And then, after Me Too and thinking, and you heard all these stories and you read all these things about how bosses can be inappropriate and say these things and, even hugging someone and all this kind of stuff. There's a lot of change in how managers can interact, how business leaders interact, and the culture that they bring around them. And I genuinely think it's been net positive. I think there have been negatives around things, around certain political correctness. I think it's probably caused a lot of people to withdraw from what used to be the office banter, although I accept some office banter was, went beyond the line, was unacceptable.
Yep.
But, that's been a real challenge over the last sort of 10, 12 years is moving into that new world, especially in real estate, because so many of the old guard, lived up to their name. They were the old guard, where it was a lot more of a male-dominated bro culture, if you like, old school bro culture that was in there, and a lot of what went on was just completely and utterly unacceptable.
Yeah, and I'm really pleased that it is changing, and certainly barriers are reducing, and people are being more open-minded when they're hiring talent into their team, which is absolutely awesome to see. As we look ahead, 2023, 2024, talk to me about your plans for TSP.
So we're quite excited. We work in the kind of flexible office space predominantly, around the sort of 2 to 3 year term certain space. So we effectively buy or manage buildings and we let them floor by floor. But what we're delivering is a product that looks more akin to a serviced office every single year. And we're trying to layer in services without increasing the operational costs too much, so that we are providing, that sweet spot of value to the end user. And we see this as a very popular space in the market right now. Work from home or hybrid work has caused a lot more people to downsize their offices. But actually what we've seen is the most amount of activity and downsizing has come from the much larger companies who are now moving into smaller spaces, which they've started appearing in our portfolios, which is new for us. We're seeing tenants creep into the portfolio that were, I don't want to say out of our league, but we didn't provide the big floor plate sort of building. So that's been interesting. Developing the product out more, that our customers become so sophisticated in terms of what they want. From taking grade A, shells or boxes, if you like, it's now they walk in and it's, do they like your furnishings? More than, anything else. It's the Instagram world of things. Does it look right? Does it fit with the brand? So we'll continue to deliver on that space. We see demand there. We see there's a very, very good sort of cohort of businesses in central London that have effectively already made the decision to say, well, we're not going to be 100% remote business and what have you. We are going to have a hub. We are going to have a place to learn, train, collaborate and what have you. And we want to carry on finding the right buildings, rehabilitating them and providing them to those people. And we'd like to continue winning awards for it. So we'll be buying into 24 and 25, and we'll continue to, we picked up a lot of management mandates towards the end of last year, and we're continuing to win some at the moment. And these are our kind of separate account clients and third party clients that are coming to us basically saying, look, we don't have the operational wherewithal to run these buildings ourselves anymore. We don't want to check out of the market. We want to stay in. We can see what's happening, but we need that operational expertise. We need you to be looking after, helping us sort of fit out and spec those things and then actually run them for us and give our customers, give our tenants what they want.
Talk to me about your rationale behind getting your B-Corp certification.
B-Corp. So again, this was something after I had taken control of the whole company in 2021. Sustainability was always interesting to us. From the early days, we sort of started to see this come through. And I think it was interesting for us because it just made so much sense. And we were trying to think of a way of how can we really demonstrate our sustainable credentials as a business that would, a bit similar to the investors and people thing, but I went about it with a bit more sort of, I was less of an idiot about why I wanted to go and do it. It wasn't just a badging exercise because it's too much work just to do it for a badging exercise. And we understood something very, very early on in our business. How well we acted on it, how much we leveraged off the back of it, I'm not sure. But we understood that the world governments were aligning to basically price sustainability into everything. And you could see it long ago with, do you remember Tom's, the shoe brand?
Yep. You buy one and they give one.
Yeah. Now that, to me, that in my mind is one of the more kind of the original of this latest generation of sustainable businesses. I mean, sustainability, as my grandmother used to tell me, has been going on a long time. You know, they used to return their milk bottles for a deposit, and they used to reuse nappies, and everything was about not wasting. Everything. But we saw this coming through, and we started to understand that certain buildings were doing better because they were more sustainable. Whether it was a marketing thing and that tenants were choosing them and paying more rent for them, whether it was when they were being sold to the investment world. The last sort of 4 or 5 years, it just came into the zeitgeist. I think Greta had huge amount to do with it, you know, to give her credit, because this has been around in popular culture now properly since the Al Gore Inconvenient Truth. And yeah, I think the tire really hit the tarmac about 5 years ago, and I think it just intensified and intensified and intensified. And so B-Corp was something we were following. I had a friend that set up a really successful business. I'll give him a shout out, actually. Jonathan Petrudes at Old Plants, who I went to uni with. And I noticed when he set up All Plants, a vegan, I noticed when he set up his business, he did B-Corp. And I remember asking him about it at the time. And he said, oh, mate, it's a ball ache. It's a ball ache.
Right into your memorandum of Articles of Association and memorandum of whatever it is, you know, the fact you're not just a pure profit enterprise, right?
Yeah. I mean, you have to expose your business to a full audit, but it's not like a financial audit. It's across everything. So changing your articles, which is basically balancing profit with purpose, that's the easy bit. You've got to ask yourself questions you've never asked yourself before. Like, out of all the suppliers to my business, what percentage of them are Black owned? What percentage of them are in general ethnic minority owned or female owned and what have you? You analyze your business down different stratas that you never, ever, ever thought about. And what's really interesting is that part of the exercise of doing that comes into the whole unconscious bias thing as well, because you can, you know, if you suddenly look at your entire supply chain and it's just old white men, then, you know, I'm not saying it's, you know, there may be some people that do have that, but you start to realize how these things affect the way the world works and how people's opportunities works and what have you. So it was really important for us to demonstrate this. And B-Corp to us, we thought it was really cool. We thought it was incredibly thorough. And I think if you're going to go and get accreditations, go for the ones where they are super, super, super fastidious, because those are the ones that are going to stick around and those are the ones that are going to be respected. And I think at the time when we got our accreditation, it came through 21, actually. July 21, we were accredited. I think we were one of 4 property companies in the UK to have it. And obviously we've seen a wave of them come through in the last year. We've actually helped quite a lot of companies do it. So after we did our launch, we were approached by tons of people saying, look, A, what is this? Or B, we're in the middle of this and it's really hard. Have you got any tips? And it's nice. It's a new community for us and we really enjoy being a part of it.
As we draw to a close, a question I ask everyone on the show is, if you were given £500 million worth of equity, who are the people, what property, and which place would you look to deploy that capital?
If I was given £500 million worth of equity, who are the people I'd work with?
Yeah, if you're going to assemble a team, who are the people that, you know, maybe you'd assemble? Who are the people that the property would be for?
Okay. The team I've got now is the one that I'd use. Cliche, I know, but I don't need it. You know, they're perfect. What properties would I buy? I'd probably go on a shopping spree of beautiful landmarks around London, if I'm completely honest with you. And I'm into old and gold. You know, I'd buy some of the classics. There'd definitely be the Ralph Lauren building on the corner of New Bond Street. I just think it's one of the best located. It's clean, it's beautiful, it's elegant, it's the right size. It's got oodles of curb appeal. I'd probably want to buy an iconic skyscraper in the city, you know, an indelible mark on the London skyline. I think the Gherkin, to me, again, it's kind of like, it's modern vintage in the city. And then I actually don't know the name of the building. There's a building on Wigmore Street that's nearly opposite the pharmacy over there, and it's beautiful. And it's almost like it's an absolute Goliath of a building, and it's beautiful, and it's like neo-Gothic. But I'd buy that.
You'd be stretching your £500 million worth of equity pretty far if you could snap up all that.
I am known for getting a good deal, so I reckon I'll make it all work.
Awesome. Well, look, Zac, thank you so much for joining me on the podcast today, sharing a little bit about your background story and what you're doing with TSP, which is absolutely awesome. Thanks for listening to this episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague, subscribe, give us a rating, like or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of which guests you think we should get on the podcast or areas of the market that we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockborn. The team recruit experienced talent for real estate private equity firms, investment managers, REITs, property companies and advisory firms across the investment, asset management, development, fund management, ESG, cap markets, investor relations and general practice space. So if you're considering your career options at the moment or looking to attract top talent to come and work for you, head over to the website www.rockborn.com where you can find a wealth of resource to aid your search. Have a great day wherever you are and I look forward to catching you next time.